Hey, so believe it or not, we may be in another refinance season. And this video is all about making an informed decision about the loan amount when you go to refinance. Don't sleepwalk through that loan amount decision because there are important implications there that you want to consider, that you want to be very intentional about, instead of just having somebody assigned to say, hey, what should the new loan amount be? And you look at your old mortgage statement and you say, oh, it should just be what my current mortgage balance is. And that may be a great answer. But it's not a great answer if it's not informed about what are the options and what are the implications of making those options. So let's talk about that. Whenever you go to refinance, there's basically two categories. There's a cash out refinance and a rate and term refinance. And the reason that matters is cash out refinances are more expensive and the underwriting is more restrictive. So typically, if you don't need the cash, you don't want to kind of accidentally stumble into a cash out decision, or you don't want to take cash out at an additional cost in terms of interest rate and fees, unless you really needed it, unless there's no better alternative to that. So typically you're going to want to do what's called a rate and term refinance. And a rate and term refinance is just simply you're refinancing your loan to take advantage of a better rate or change your term, going from a 30-year to a 15-year, or 15-year to a 30-year, or rates are better. More commonly, that's why people refinance. Rates are better and I just want to refinance. But what can get confusing about that, there's a lot of nuance to determining whether it's a rate and term or a cash out refinance. For example, a rate and term refinance can result in considerable positive cash flow to you through the refinance process. You can end up with cash in pocket and then even more positive cash flow because of what happens after closing. And that's still considered a rate and term refinance. And that may be a great result for you. That if you got cash back and it's still a rate and term refinance. So it's important that you're very intentional about making that decision about what kind of a loan am I getting, why am I getting it, and what's the optimal loan amount based upon that. So for this example, we're going to assume that your rates are better. And my assumption specifically, I'm going to assume that you bought this house in April of 2023. And yes, as I said below, believe it or not, we could be in a season where we can start to refinance these loans already, right? Rates have come down fairly sharply over the past month, and they look to continue for the time being. We don't know if that's going to continue, but they look like they might. So if you bought the house in April of 2023, it might be time to consider a refinance already, or even more recently than that, when rates have kept going up for a while until the last month or so. And now it's October, and you're going to refinance out of this house. And your basic premise here is rates are better and I just want to refinance. The the loan amount is $400,000. You look at your mortgage statement and it's due for the October 1st payment and it's $400,000 loan amount. And your old rate's 7% and your new rate's 6.5%. So what are the decisions you're going to make with regard to loan amount? Now, some people just think, I don't want to add to my loan amount. The only reason I'm refinancing here is because rates are better. I don't want to add to my loan amount. And that can be a great decision, but just understand that you may end up with writing a check for $11,000 at the closing table. Now, why is that? Think about it this way. A couple of things are going on here. When you are paying off a loan balance of $400,000 based upon your mortgage statement that showed that you owed $400,000, by the time you pay that off, there's going to be additional accrued interest. Every day after the first of the month, that mortgage statement shows you here's what the amount is due after you made your last mortgage payment last month. Here's the new payment due. But that amount that you owed at the beginning of the month is accruing interest every day until you pay it off. So first of all, they're going to add that to the payoff balance. So you're not just paying off the $400,000, you're paying off that plus accrued interest. And typically there's some small processing fees associated with that too, maybe $150 or $200. That's going to get added in. But then the bigger items, of course, are when you refinance your loan, you've got certain transaction costs. Now, on the official loan documents, the transaction cost, there's an element called settlement cost. And that can be a little bit confusing because what it does, settlement cost conflates two different things. You've got the actual fees associated with getting that loan. And then in addition to that, you've got the what's called prepaids and reserves, which are those costs associated with owning your property that have to be reestablished with the new lender, like real estate taxes, homeowners insurance. If you're paying your taxes and insurance as a part of your mortgage payment, and your current lender has an impound account or an escrow account where they're holding funds to make those payments for you, that money belongs to you and you're going to get that back after closing from the old lender after they get paid off. But the new lender has to have that reestablished. And so the combination of your fees, your title, escrow, appraisal, credit report, etc., plus the reestablishment of taxes, insurance, and interest reserves, combined, those are called settlement costs. And in my example, we're running like a $400,000 refinance. That amounted to about $8,800. So when you combine all that, you just got the same loan amount. You just want to borrow $400. You don't want to add to it, but you're going to roll in about $8,800 of settlement costs. Plus, you're going to have accrued interest on top of the $400,000 when you're paying off the old lender. So all told, you're going to come to the table with $11,000. And again, that may be a great decision, but you don't want to be surprised by that decision, and you don't want that decision just simply imposed upon you because your loan officer didn't ask you to think about or explain to you the implications of these different things. So we're going to start though with that example. So same old loan amount, you have $11,000. Now what happens after closing? Typically when you refinance, you're going to skip a mortgage payment. Let's say that we close out the old loan and we close the new loan in October 20th of 2023. Now, the old loan, typically you made a payment October 1st or by the 15th of that month, and your next payment's due November 1st. But now you've paid off that old lender and you don't owe them a payment anymore. And the new lender, typically you close October 20th on that new loan, but the lender doesn't have time to get you in the system, get you set up, send you a statement, and have you make a payment by November 1st, when you would have had that first payment due on the old loan. So that first payment due on the new loan isn't until December 1st. So you're skipping that mortgage payment. And you're still incurring interest. It's not like you're getting a free month or a free half of a month. You're still incurring interest for that period of time, but you skip that mortgage payment. You don't start till December. So that really is a cash flow benefit. You're going to skip a mortgage payment. And in my example here, again, I had a $400,000 mortgage. I had taxes and insurance of $650 a month, and I had an interest rate of 7% on the old mortgage. And it just, it amounted to $3,311 per month. You're skipping that payment. So that's going to offset this $11,000 that you had due at closing. And then you also had about a $1,700 balance in your impound account. I assumed $6,000 a year for real estate taxes, $1,800 a year for homeowners insurance. And I just did a projection of, okay, what would my escrow account have by the time October comes around and I've made that October 1st payment? Well, this is what it was going to be. So you get an escrow refund of $1,700. So in this case, you are $5,900 in the red, negative net cash flow. And then this may be exactly what you wanted. You may be thinking, yeah, that's just fine. That essentially means I'm paying out of pocket for the refinance expenses associated with this, and I'm good doing that because I'm getting a lower interest rate, and over time it's going to provide enormous benefit, and I'm okay using that cash. But maybe instead you say, no, I want to roll the closing cost in. I don't have $11,000, or I don't really want to use $11,000. I'm okay rolling those costs in because I know over time with that lower interest rate, I'm going to more than make up for that. And so now in this case, if you rolled the $8,800 that we talked about, now you're $11,000. Instead of $11,000 cash to close, you're going to bring $2,200 because you didn't borrow $400,000, which we just picked because it was the loan amount on the mortgage statement, the exact loan amount as you had going into this refinance. Now we said, no, roll that $8,800. And remember, that's comprised of actual fees associated with getting your loan and then also the prepaids and reserves. You're rolling that $8,800, so you're borrowing $4,088 in this case. So your cash to close comes down to $22. But note here that you're still going to be cash flow positive when it's all said and done because you still get to skip a mortgage payment and you still get a refund of your impound account. So your net cash flow positive $2,700. And again, that may be a great result for you, but what you don't want to do is inadvertently fall into a positive cash flow position that you financed into the new loan. You increase that new loan amount to $4,088, and as a result, you have positive cash flow of $2,700. And if you didn't need that or didn't want that, that means you financed a deposit into your savings account on a 30-year mortgage of $2,700. So maybe in this situation, if it's explained to you properly, say, look, I want to roll my closing costs. I really don't want to write a check at the closing table, but I'm okay writing a slightly bigger check so that at the end of the day, after I get my refund and my earnest money or my escrow account from my current lender, and after I skip a mortgage payment, then I'm net negative cash. Then I'm net zero cash flow. And in that case, you'd have borrowed a little bit less. You'd have brought about $5,000 to the closing table, and then it would have been fully offset by these subsequent events. And you would have been truly net cash flow neutral in that situation. Now, here's a situation where maybe you just say, look, I don't want to bring any cash to the closing table. I don't have it, I don't want to bring it, or I just would rather conserve cash. I'll bring zero cash to the closing table. Great result. Remember, all of these can be done under the rubric of a rate and term refinance. Lower cost versus a cash out, and easier underwriting and potential, lower rate and potentially lower transaction cost as well. And notice in this example, you bring zero to the closing table. It's a rate and term refinance, and you're walking away with $5,000 positive cash flow because you skipped your mortgage payment and you got an escrow refund. So that could be a great result for you if that's the intent. And then finally, just also understand that both Fannie and Freddie have some flexibility as regards to whether, to the net cash position at the closing table. They both allow you to have a little bit of cash back at the closing table. And this can really work to your advantage if you know what you're doing with it and if you're very intentional about it. Because remember, cash out refinance is more expensive and a more strict underwriting situation than a rate and term refinance. Well, if all you need in this case is like, let's say $9,000 cash out, if that's enough to really make a difference in your life and you really want that cash out, you could actually achieve a positive $9,000 cash flow and still have it be classified as a rate and term refinance. And that's just, this is basically what I call a backdoor cash out, where Fannie Mae and Freddie Mac, so Fannie lets you have the lesser of 1% or $2,000. So the max you can ever get on Fannie Mae rate and term refinance is $2,000. Or lower if 1% of the loan amount is lower. So if you're borrowing, $180,000, that would be $1,800 that you're limited to. Freddie kind of takes a reverse approach and says, we'll give you the greater of 1% or $2,000. So at worst, you can get $2,000 cash in pocket at the closing table. Or if 1% of the loan amount is higher, they'll give you that. In our example that we're working on here, we have a $400,000 loan amount. 1% of that is $4,000. So you can actually have escrow write you a check of $4,000. Remember, you're financing all of this. All of this is achieved by picking a loan amount. But you can get $4,000 cash at the closing table. You still get to skip your mortgage payment. You still get the refund of escrow. And so now here you're positive $9,000 cash flow, but you got the benefit of a rate and term refinance. And where it's particularly important here in this scenario is that you don't stumble into the situation where you go to a loan officer or you go to a call center lender and they don't really evaluate, they don't really probe and ask questions as to what are you going to do with this cash, how much do you really need? Because let's say you just said, hey, I need about $10,000 cash out. And so they said, okay, and they do a cash out refinance for you. So the rate's higher, the fees are higher, the process is a little stricter, and fine, you get what you want, you got your $10,000. But what if they would have told you, look, actually, we can get you $9,000 and still call it a rate and term refinance, and then we'll give you a lower interest rate, potentially lower fees, and easier process. Would you like that? Now maybe that's not enough. Maybe you really need that full 10, and that's fine. But what's not fine is that you just stumbled into that decision without being told, look, you can actually get $9,000 cash back, net positive cash flow from this, and get the benefit of a rate and term refinance. So my point here again is just to illustrate the different decisions that you should make and the implications of those decisions, and making sure that you make those decisions on a very intentionally and very informed basis. Thanks so much. Let me know if there's anything I can do to help. If you like this channel, please subscribe, follow, and look around for other informative videos all around the mortgage space. Thanks so much.